Welcome, everybody, to Stock Talk with Nico Criticos. Today, we're going to do some stock analysis for Blackrock, ticker BLK. If you do not know, Blackrock is the world's largest asset manager. As we can see here, they manage $8.6 trillion of assets as of December of last year. On their investor presentation, here we can see how their client type is divided up between institutional investors, retail investors, and then the ETFs. So, first thing we're going to look at for this company is going to be their revenue. And the revenue chart for this company looks great. Over the last 10 years, they're growing at about 7% per year. So keep in mind, this company is a $96 billion company. And in 2021, it peaked at $971 a share roughly, and now we're down to about $645. So we're going to find out if this is a good investing opportunity for this company or not, because being the world's largest asset manager, sure, they can have other competition take them over, but that is a pretty strong moat. So revenue is growing at an average of 7% per year. Net income over the last 5 to 10 years is growing. I like to look at the 10 years. So we'll say they're averaging 7% net income growth. Then we're going to go to the P ratio. If we look at their price to earnings based off of 2023 earnings estimates of $35 of EPS, we're looking at a forward PE ratio of 18. If we compare that historically, we can see here that an 18 is definitely on the higher side of things, right? This is where we're at. We're about at an 18.4. So we've seen it go as low as a 9 and as high as a 23. So 18 is definitely on the higher side of things, and I would not be surprised if this came back down to a 15. A 15 looks like where it's fairly priced. Now, keep in mind, some companies that build large moats and, more dominance over their industry, they can trade at higher premiums as time goes on. So that is always an option. Like McDonald's is a good example of that, or Costco is a good example of that. But in this case, it looks like this company likes to come back to around this 15 to 16 PE ratio. And oftentimes it'll even go below that down to like a 12. So you got to be careful. I don't want to say this is a bad time to buy, but really, I wouldn't even think about buying until it's around 580, 550, or really down to about 550, 560. I would say that looks like a healthy spot to get in, or 15 to 16 times earnings. Then we're going to look at the innovation for this company. I don't really see a lot of innovation. I see a large moat, which is definitely respectable. I don't see a lot of innovation. Strong market share, yes, they are number one. Return on invested capital, unfortunately not. I think this is partly because of how big they are, how much money they manage. It probably is harder to keep up solid returns. As you can see, in the early 2000s, they were doing 25% plus numbers. Nowadays, we're looking at 2% to 5%. The good thing is, in the last decade, they've actually have grown this number from 2% to 5%, so it's not getting any worse, which is a good thing. But 5% is definitely low. It's not a lot. The equity for this company is growing steadily but slowly, I guess you can say. I think it's gone from about 34 billion to about 38 billion. So, not anything crazy, but they're at least keeping up with things. And it also, the other good thing about this is it's way over 15%. Yeah, 34 to 38 billion in equity. And it's definitely over 15% of the market cap, because remember, it's roughly $100 billion company. So that's pretty solid right there. The other thing I like about this company is their share count has been decreasing 1 or 2% per year for the last decade plus. That's another good thing that I like to see. Their assets, of course, are not 2x the liabilities. Pretty much, there's not many companies that have that. Profit margin is 29%. This was a little bit more surprising because normally profit margins correlate with return on invested capital numbers pretty to some degree, but 29% is very high. Cash and receivables is roughly 10 billion, while their average annual income is 5 billion in the last year, so that's good. Healthy dividend, the payout ratio is only, I think it's 40, 50%, something like that. No, 60%. Okay, so still not bad. It's over 20 years old. They came out in the 80s. And then the most important thing here is the free cash flow, which they are growing. So that's one of the best indicators for a stock performance, I think. And over the last 10 years, they've grew free cash flow about 7 to 8% per year. So I'd be happy to buy this company if the stock went down to a 15 times earnings.